Welcome to StockTok's deep dive into Barrick Mining. Barrick is one of the world's largest gold producers, with a portfolio of operating mines and development projects across North America, South America, and Africa. The company extracts and sells precious metals, primarily gold and silver, to a global market of investors, central banks, jewelry manufacturers, and industrial users. Barrick matters to investors because gold is both an inflation hedge and a macro risk indicator, making the company's performance sensitive to interest rates, currency movements, and geopolitical uncertainty. Over the past 52 weeks, the stock has traded in a range from $17.41 to $54.69, establishing Barrick well within the middle and upper portion of that band. As of May 8th, the stock is trading at $43.13. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Barrick Mining generates revenue by extracting gold and silver from geographically diversified mining operations and selling those metals at global spot prices. The company's competitive advantage rests on three pillars. First, a world-class asset base, meaning Barrick owns some of the largest, lowest-cost ore bodies on Earth. Second, operational efficiency. The company has invested in modern mining technology and process improvements that allow it to extract metal at a lower per-unit cost than many peers. And third, financial scale. Barrick's size gives it negotiating power with suppliers, access to capital markets, and the ability to invest in exploration and mine expansion that smaller competitors cannot match. The StokTok score for Barrick Mining stands at 66 out of 100, which signals a buy across 5 dimensions. Financial health scores a perfect 20 out of 20, a fortress balance sheet. Profitability scores 17 out of 20, excellent operational margins. Growth scores 14 out of 20, steady, but not explosive. Valuation scores only 7 out of 20, the market is pricing in premium expectations. And smart money scores 8 out of 20, mixed conviction among institutional investors. Now valuation. The question every investor has to answer: are you paying the right price? Barrick trades at a price-to-earnings multiple, or PE, of 13.24 times trailing 12-month earnings. For a gold mining company, that is neither cheap nor expensive relative to peers, which typically range from 10 to 18 times earnings. The price-to-earnings growth ratio, which divides the PE by expected growth rate, comes in at 1.57. This suggests the stock is trading roughly in line with its growth rate. The enterprise value to EBITDA multiple, a metric that compares the total cost to buy the company to its operational cash generation, stands at 6.61 times. That is a reasonable multiple for a mining company with Barrick's scale and profitability. Our DCF model, which projects future cash flows and discounts them to present value, suggests the stock is trading at 0% premium to intrinsic value, meaning the current price aligns with what the business is intrinsically worth based on those assumptions. Wall Street analysts have a consensus mean price target of $57, which implies upside of approximately 32% from current levels. The distribution is fairly wide. The high target is $70, and the low target is $31, reflecting genuine uncertainty about where metals prices and interest rates head. Taking both signals together, a reasonable fair value range in our view sits between $51 and $61. Barrick is also approaching its next earnings announcement, scheduled for May 11, 2026. Consensus expectations for earnings per share are 81 cents, with estimates ranging from 68 cents to 96 cents. That's a meaningful range, suggesting the market is watching for surprises on either metals prices realized or operating costs incurred. Market sentiment around Barrick leans bullish. The company has recently secured funding for gold projects, appointed new executives to oversee a spin-off of North American assets, and been recognized by analysts as a top precious metals pick. However, that bullish sentiment is tempered by broader concerns around artificial intelligence volatility and crude oil price pressures that can ripple through the mining sector. The valuation setup, in our view, suggests Barrick is fairly priced, not cheap. There is limited margin of safety at current levels. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point checklist that grades balance sheet and cash flow quality on a 0 to 9 scale. Barrick scores a perfect 9 out of 9, which means it passes every single test. The company is profitable, has positive operating cash flow, is reducing debt year over year, has growing earnings, maintains stable share count, shows improving asset quality, and demonstrates improving liquidity. This is a fortress scorecard. The Altman Z score is a 5-variable bankruptcy risk model that combines profitability, leverage, liquidity, solvency, and activity ratios into a single figure. Barrick scores 3.50, which places it solidly in the safe zone. Scores above 2.99 indicate very low bankruptcy risk. The company's cash-to-debt ratio stands at 1.29, meaning Barrick has $1.29 in cash for every dollar of debt outstanding. That is excellent. Most mining companies operate at ratios below 1.0. Interest coverage, which measures how many times the company can pay its interest expense from operating earnings, is an extraordinary 21.29 times. Put another way, Barrick could cut its operating earnings by 95% and still comfortably pay interest. The current ratio, which compares short-term assets to short-term liabilities, stands at 2.92, well above the 1.0 minimum required for solvency. The debt-to-equity ratio, which shows leverage from the shareholder's perspective, is only 0.20. That means for every dollar of shareholder equity, Barrick carries only 20 cents of debt. In practical terms, this is a company with exceptional financial flexibility. It can invest in new projects, return cash to shareholders through dividends or buybacks, weather commodity price downturns, or pursue strategic acquisitions without financial distress. The balance sheet is not a constraint on Barrick's strategy. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or ROIC, stands at 15.56%. That represents the after-tax profit Barrick generates for every dollar of capital deployed in the business, whether that capital came from debt or equity. 15.56% is excellent. It exceeds the company's estimated cost of capital and suggests management is deploying shareholder funds into projects that create value. Gross margin, the profit left after paying direct mining costs, is 51.2%. That is a very healthy margin, reflecting both the favorable commodity price environment and Barrick's operational efficiency. Operating margin, the profit from core mining operations before financing and taxes, is 47.16%. This is remarkable. Nearly half of every revenue dollar converts to operating profit. That demonstrates the inherent leverage in a mining business once you achieve scale and operational excellence. Net margin, the bottom line profit after all expenses and taxes, is 29.36%. That means Barrick converts more than $1 of every 4 revenue dollars into actual profit that belongs to shareholders. Free cash flow margin, which measures cash generated from operations minus capital expenditures as a percentage of revenue, is 22.81%. This is crucial because cash, not accounting profit, is what the company can actually distribute to shareholders or reinvest. The margin profile tells a clean story. Barrick is a high-return, high-cash generation business. The latest quarterly earnings, reported approximately 12 months prior, showed the company beat earnings estimates by 17% and generated net income of $2.41 billion on revenue of $6 billion. That net margin of 40.2%, even higher than the trailing 12-month figure, underscores the profitability strength. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years averaged 16.10% per year. That is a solid growth rate for a large-cap mining company and reflects a combination of higher gold prices and rising production volumes from operational ramp-ups at key assets. Over the longer trailing 5-year period, growth has averaged 8.00% annually, still respectable but lower, suggesting that much of the recent expansion is being driven by commodity price strength rather than production growth alone. Book value growth, which measures the expansion of shareholder equity on a per-share basis, has been 7.50% over 3 years. This is lower than earnings growth, likely reflecting share buybacks and dividend payments that return capital to shareholders. The dividend yield stands at 2.15%, providing a modest income stream for investors and signaling management confidence in cash generation. The growth picture is steady but not explosive. Barrick is not a company in hypergrowth mode. That would not be realistic for a mature mining operator serving a commodity market. Instead, the company is capturing higher gold prices, ramping production from development projects, and gradually expanding its resource base through exploration success. The latest quarterly results showed revenue growth of 44.60% year-over-year, but that figure is unusually strong and likely reflects a significant commodity price spike in that particular period. Investors should expect normalization to the historical mid to high single-digit growth rates as the market cycles. Now let's talk smart money. What institutional capital is actually doing with this name? 16 top-tier investment gurus currently hold Barrick in their portfolios, according to Dataroma's tracking of 13F filings. The quarterly disclosures that fund managers with more than $100 million in assets must file with the Securities and Exchange Commission. However, the picture is more nuanced when we examine the direction of those holdings. Sarah Ketterer, the portfolio manager at Causeway Capital Management, holds Barrick as 3.65% of her portfolio, but has been reducing her position by 61.17%, suggesting a shift away from the stock. Howard Marks, the legendary credit investor at Oaktree Capital Management, holds the stock at 2.86% of his portfolio, but is also reducing by 9.90%. First Eagle Investment Management, another storied firm, holds 2.47%, but is trimming by 16.93%. These are not trivial positions for prestigious managers, and their reduction signals caution. Only 5.40% of all 13F filers that disclose their holdings show net buying activity, defined as more than 50% new purchases versus sales. That is a relatively low number, suggesting institutional investors are taking a cautious stance. Insider ownership at Barrick is 0%, meaning company executives and board members own virtually no shares, which is unusual and somewhat concerning. When management owns no skin in the game, it can reduce accountability to shareholders. Insider transactions over the last 3 months show 0 buys and 0 sells, confirming the complete absence of insider activity. The smart money picture is mixed. Large, experienced investors own the stock but are slowly exiting positions, and management shows no personal conviction through share ownership or purchases. This divergence between Guru holdings and Guru actions deserves attention. And finally, the verdict. Let's bring it all together. On valuation, the stock is fairly priced at current levels with a fair value range of $51 to $61, implying upside of approximately 18 to 41% from current levels but very little margin of safety. On financial strength, Barrick operates with a fortress balance sheet, a perfect Piotroski score, exceptional liquidity, and minimal bankruptcy risk. This is not a constraint. On profitability, the company converts nearly half of its revenue into operating profit and more than a quarter into net profit, with ROIC of 15.56%, well above its cost of capital. This is a genuinely excellent business. On growth, Barrick is expanding at a mid-teens rate over 3 years and delivering mid-single-digit growth over 5 years, driven by commodity prices and production ramps, steady but not explosive. On smart money, top institutional investors own positions but are quietly reducing exposure, and management owns virtually no shares, which suggests a lack of conviction at current valuations. In our view, a fair value range for Barrick Mining sits between $51 and $61, representing 18 to 41% upside from current levels. The latest quarterly earnings, reported approximately 12 months prior, showed the company delivering a 17% beat on earnings per share and generating extraordinary profitability metrics. The setup presents a company that is fundamentally sound, operationally excellent, and financially strong, but one where institutional investors and company insiders are signaling caution. The bull case rests on continued commodity price support, margin expansion from operational leverage, and the near-term catalyst of the upcoming earnings announcement and the North American asset spinoff. The bear case rests on the fact that much of the recent growth is cyclical, reflecting commodity prices rather than structural production growth, and that top investors are already reducing exposure at these valuations. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Barrick Mining. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.